Hello everybody, it's Andrew Pancholi here on Friday the 13th of March. It is just coming up to 20 past 3 in the afternoon, 4-hour time change ahead, so 20 past 11 in the morning New York time. Let's have a look now. If you watch this video, this is just going to be a short one. It is for our market timing report trading course members and our readers, and please link it up to the longer video I did a few days ago on the 9th. That has all the background information in. So let's take a look and see what's happening. The first point I want to make from the S&P section of our market timing report for March was that we did have this very big spike here, and this is actually for the 17th. The rest of the dates are earlier on in the section. The 17th is 2 trading days away from now. So that's a point where I did expect to see a reversal. We will probably see a reversal then, so that's point number 1. Bear that one in mind. The next point I want to make is that we showed you these retracements the other day. The 38.2% level is here at 2,357. Now this is the cash index. Now take a look and see what happened on the futures overnight. Moving this same chart over, and the reason I can't show this is we've only got futures data back to this point into a perpetual chart to show you this retracement level, but we did get all the way down to pretty close to that level. We didn't actually touch it. I've got 2 different readouts, like 23.74, 75 I did see. So we got very close to that. We got close to a double bottom. So this is really important. So we've got, first of all, this potential turning point date. We've got down to this level. Those are the next factors. So this is the next point, and this really comes from our trading course, and for those of you who've been following the report for several months or years, you'll have seen these lines being drawn in, and we used these 2 points to project this low here. We took these from there to there, added it to there, it gave us that low there, and then we got this next point exactly, and we teach this in the course. Now look where we got to, and this is more important than anything else. This is the point we touched, and that is why I'm now looking, we are 2 days ahead of our potential turning point, 3 days ahead, but price has got to a point that I would consider really important support. Now, given that we got to the 382 level, price is overruling time, and we want to see if this level here holds as well as the 382 level I just showed you a short while ago. This is really critical for the market. So we should be seeing a bounce here, and of course the markets are bouncing today. And let's see whether this is a significant low with follow through, or whether we are going to see a break of this in a few days' time. I think, we have started this 90-year cycle and sell-off, so in the longer term we will go lower. But also, if we do see a pullback to here, then the 50% retracement in our 3D section would take us up to this level here. So that's a key level. And if we were just to put a regular Fibonacci retracement in, then we would really say, well, we could take this high here. Let's just lock that in, pop the high in there, and this low here, like that. And that then shows us 29.36. We'll just reverse them over, around about 29.36. But we might just stop shy of it, you see there as well, because of this line being slightly lower, depending on when we get there. We could also get to this point here, and this is why these lines are more important than the Fibonacci levels. So just watch out for that. And there's one other point I want to make on the S&P, and here is that point. So this is showing you here the Fibonacci retracements we were looking at. We showed you the futures chart had just come shy of this, and we're trading up here now. This was our measure of a bear market and an exceedance of this level here, or the parallel of that. Well, we've had both of those, so this is now starting to look significantly bearish in the longer term, and that's a significant correction. Now what I've done is added the next warning line over. So this was our key pitchfork here, and we came over and we hit that line there. Now we've hit this line here. So this line here is tying up with this massive long-term second warning line. There was an exceedance, but also we had those other lines in there which were also lining this situation up there as well. So these are reasons why we're at a significant support level, and we need to be on alert for, there's two factors: alert for a significant rally pullback, because this is a big pullback, but also we need to be aware and look for a break of this would be very bearish indeed. One thing that hit me was when we look at the global financial crisis and take a look at this. This is just in absolute terms, not in percentage terms. But if we take this from here to here, around about 890 points that move was there. Well, we've already way exceeded that in just a handful of days. A couple of weeks. We've done 916 points, 891 points, and that that there went effectively, arguably, from October 2007 to March 2009. And we just did this in days. Now, I know in percentage terms it's not quite the same, but just be aware of the magnitude of this move. So that's the S&P 500. I also want to point out in our report, we were talking about crude oil, a major weekly turn falls during the week ending 13th of March. And today, the 13th of March, is actually a turning point date as well, tying the two together. So I'd be looking for a significant reversal here on crude oil. Now, bear in mind that these cycles are very clear on crude oil. We have a minor cycle, which I didn't publish in the report for this week on the S&P. But it could well be that the reversal up in crude could then obviously impact, or would impact, the equity market. So this is putting it all together. Looking at the crude oil chart, quite simply, using again the techniques we use in our course, that projected, we got these here projecting this area here, which I did show you earlier in the week, I think in a separate video, or certainly in something we popped out, and that's holding now, and we'd probably want to see this gap being filled. I don't know whether it's going to get filled. It's such a big move down, but I would say the downside is limited, at least in the short term, especially with this weekly cycle. And the midpoint line there is proving that this is a relevant point. We can see some testing of that. So those are just some quick points. I didn't want to make it a very long video. I hope you find this useful. And www.markettimingreport.com. Have a look. There's a few things up there, and we'll speak to you soon. Be safe, and we'll speak soon. Oh, and a couple of other points, actually. I've had several phone calls. Yes, let me just a little bit, was moving away to the current situation and the COVID-19 virus. We did talk about this in the reports, but I've had a couple of phone calls and done some interviews. Yeah, so check this out. As I said, and the regular readers know, it's an 18 to 18.6 year cycle. So right now we're dealing with COVID-19, and go back 18 to 19 years, you'll find that SARS was prevalent. Go back another same cycle, 18 to 19 years, and you'll see that we had AIDS and HIV was starting to proliferate. And also going back a little bit further, there was the same cycle again, brought in China flu. But what I thought was really interesting was also that we've got mass hysteria at the moment and world panic. And that's exactly what we had 18.6 years ago, because that was 9/11. After the 9/11 attacks, every city around the world was fearful for jets being flown into buildings for a while. So these panic cycles are following these 18 to 19 year cycles. It's all coming together. So remember, these things will pass, but we are in the thick of it at the moment. So stay safe, and I'll be in touch soon. Thank you.